Imagine a time when Wall Street wasn't just a street but a place of chaos and uncertainty. In 1907, America faced a significant financial crisis before the Great Depression. It's called the Panic of 1907, and it was so severe that one man, J.P. Morgan, stepped in to help stabilize the situation. Let's dive into how this happened. Back then, banks were not as regulated or interconnected as they're today. When a major brokerage firm failed in 1907, panic spread rapidly. People rushed to withdraw their money from banks, which had to close due to insufficient cash reserves. The trigger was an attempt by one financier, Frederick A. Chase of United Copper Company, to corner the market for copper, which is both risky and illegal if it involves manipulation or fraud. When this failed, his firm faced bankruptcy, causing panic among investors who then started withdrawing their money en masse from banks across the country, leading to a run on several financial institutions. But here's where things get interesting. J.P. Morgan stepped in with a plan. He played a crucial role during the Panic of 1907, acting as a stabilizing force in the financial system. How did he manage to help? First, Morgan called all major bankers to his office and urged them to bring cash reserves. The bankers complied because they understood that chaos in the financial system could threaten the stability of their own institutions. Next, Morgan worked on stabilizing trust companies. These were financial institutions that issued loans but were not protected by deposit insurance. During the panic, when people rushed to withdraw their deposits, these institutions faced collapse. Morgan coordinated large-scale transfers of funds to keep them solvent. Then came the financial crisis of 1907, often referred to as the Panic of 1907. During this period, major banks faced runs and liquidity crises, but the New York Stock Exchange did not shut down for a week as it continued to operate, albeit under significant stress. J.P. Morgan played a crucial role by working with other financial leaders to provide liquidity to troubled institutions and negotiating deals directly with traders to stabilize the market. His involvement signaled confidence in the system's ability to recover, encouraging others to maintain their trust in the financial markets. But Morgan's methods weren't just financial. He also relied on social influence. He met with key figures privately and used his considerable sway to encourage responsible actions. When major banks agreed to provide loans under more favorable terms, the panic began to ease. So how did this play out financially? By the end of the Panic of 1907, Morgan had orchestrated a bailout that cost him millions of dollars personally but likely saved billions in today's economic terms for the nation's economy. And all without government intervention, since this was before there were federal regulations or safety nets like deposit insurance. But here's a twist. Despite J.P. Morgan's efforts, many people still lost their savings and businesses went bankrupt. The panic wasn't just about money, it was also about trust in the financial system. People panicked because they didn't know whom to trust or what would happen next. Now let's look at the numbers. During this time, banks across the country saw billions of dollars withdrawn overnight. Some estimates suggest that between $80 and $140 million were pulled out, roughly equivalent to over $3 billion today when adjusted for inflation. The stock market lost nearly a third of its value in just days. Imagine if you lost a significant portion of your income for several months in a row. The economic disruption caused by events like the Panic of 1907 could lead to financial difficulties lasting much longer than just a few months, impacting people's lives profoundly. But here's where it gets really interesting. The Panic of 1907 led to major reforms. People realized that banks needed better regulations and oversight. This eventually led to the creation of the Federal Reserve System, which was established in 1913. The Fed was designed to prevent similar crises by stabilizing the financial system through various tools and policies. So while J.P. Morgan's actions were crucial for stopping immediate chaos, they also highlighted the need for systemic changes. After the Panic of 1907, there was a push for more transparency and oversight in banking practices, which laid the groundwork for future regulatory reforms, but still fell short compared to today's heavily regulated environment. But here's another twist. Despite all this drama, many people believe that Morgan himself profited greatly from the crisis. After the panic subsided, some of the companies he helped stabilize saw their values rise again. While it's true that J.P. Morgan and his associates were in a position to make strategic investments during times of market distress, there's no definitive evidence that he personally made substantial profits directly from the Panic of 1907 by buying companies at rock-bottom prices. So while Morgan was seen as a hero by some, others saw him more as an opportunist taking advantage of the chaos. This highlights a key point. In times of financial crisis, there are always winners and losers. Those with access to insider information or privileged positions often find ways to benefit even when everyone else is suffering losses. Another interesting angle is how this panic affected everyday people. Many lost their life savings, businesses failed, and unemployment increased dramatically. People who had been saving money for years saw its value diminish significantly due to bank failures and economic instability. This is why financial education became increasingly important after the crisis. People needed to understand better how to protect themselves during volatile times. But here's a counterintuitive fact. Despite all this turmoil, not everyone lost everything. Some individuals managed their finances wisely and weathered the storm. They had emergency funds set aside, diversified their investments across various asset classes, or simply kept more cash on hand than they normally would have. These strategies proved valuable during the panic. Now let's break down how Morgan's plan worked in practice. 1. Cash mobilization. JP Morgan gathered as much cash as possible to inject into failing banks and businesses, which was crucial for stopping immediate liquidity crises and allowing these institutions to resume operations. 2. Stabilizing trust companies. By coordinating large-scale fund transfers, Morgan helped keep trust companies solvent, preventing them from collapsing entirely. 3. Negotiating deals. He met with key financial leaders and negotiated deals directly, including lowering interest rates on loans and stabilizing the stock market by ensuring the New York Stock Exchange reopened under more controlled conditions. But here's another crucial aspect: transparency and communication. JP Morgan openly discussed his plans, which helped build confidence among investors and the public. When people learned that a prominent financier was personally involved in stabilizing the financial system, it reassured them that steps were being taken to address the crisis responsibly. Now let's dive deeper into some of the financial mechanics at play during the Panic of 1907, when JP Morgan played a crucial role in stabilizing the market by coordinating with other leading financiers to provide liquidity and reassure investors. This period highlighted the importance of central banking and led to the eventual creation of the Federal Reserve System in 1913. Subject: the Panic of 1907, JP Morgan's rescue plan. Trust companies. These institutions were essentially banks but without federal deposit insurance, which was introduced later with the establishment of the Federal Deposit Insurance Corporation, FDIC, in 1933. They issued loans based on assets like mortgages and securities. When people panicked and withdrew their deposits en masse, trust companies had to sell these assets quickly, often at fire sale prices, leading to financial distress and potential collapse for these institutions. Subject: the Panic of 1907, JP Morgan's rescue plan. Banks' reserves. Back then, most banks kept very low reserves. Only about 10% of deposits were backed by cash or securities. So when panic hit, they ran out of money quickly. Now let's look at the long-term impact. The Panic of 1907 led to significant changes in banking regulations. People realized that without oversight and safety nets like deposit insurance, crises could happen again. This is why we now have systems like FDIC, Federal Deposit Insurance Corporation, which was established during the Great Depression and guarantees deposits up to a certain amount. But here's the kicker: despite all these reforms, financial crises still occur. They just manifest differently today due to improved regulations and more transparent markets. However, the underlying issues, such as panic leading to a run on banks and withdrawal of funds, remain eerily similar. So how do we prevent future financial crises? One approach is to educate people about sound money management practices. If individuals understood the importance of basics such as maintaining emergency funds and diversifying their investments, they would be significantly more resilient during economic downturns. Now let's circle back to JP Morgan. While he was hailed as a hero by some for his quick thinking and decisive action during the Panic of 1907, others saw him more as an opportunist taking advantage of chaos. This duality is important because it shows that even in times of crisis, there are winners and losers, and sometimes the system benefits those with inside knowledge. But here's another angle. Morgan's actions also underscored the importance of trust in financial systems. When people see someone like him stepping up and stabilizing things, confidence returns. This is why central banks today often play a similar role during modern crises. They inject liquidity, lower interest rates, and reassure markets that they're working to restore stability. Let's examine some concrete examples from the Panic of 1907. Subject: the Panic of 1907, JP Morgan's rescue plan. Trust company failures. During the Panic of 1907, several trust companies faced failures, with the Knickerbocker Trust Company being a notable example. This institution collapsed when it could not meet withdrawal demands, triggering a chain reaction that affected other banks' stability as well. Market decline. The stock market experienced a significant decline during the Panic of 1907, though exact figures are not reliably recorded for that period. This event severely impacted wealth and investor confidence. But amidst all this chaos, there were moments of heroism and innovation, such as the efforts by financier JP Morgan to stabilize the financial system during the Panic of 1907. Subject: The Panic of 1907. J.P. Morgan's rescue plan. Morgan's midnight meetings with bankers were legendary. He would call them into his office and facilitate coordination, often at the cost of significant sums from his own pocket, to stabilize failing financial institutions. These meetings helped align efforts across different banks and brokerages, preventing a broader collapse during the crisis. And here's a key takeaway. While Morgan's actions were crucial for stabilizing things in the short term, they also highlighted the need for systemic changes. The Panic of 1907 was instrumental in pushing for better banking regulations and oversight, leading to the creation of the Federal Reserve System, which still shapes our financial system today. So let's break this down further. Subject: The Panic of 1907. J.P. Morgan's rescue plan. Passage to fact check. Immediate impact. Morgan's quick mobilization of cash and coordination among banks prevented a deeper financial collapse. His actions showed leadership by example, as he personally committed his own funds to stabilize the market. Subject: The Panic of 1907. J.P. Morgan's rescue plan. Long-term impact. The crisis led to the creation of the Federal Reserve System in 1913, which was designed to provide a more stable and flexible monetary system to prevent similar financial crises from occurring again. Now let's look at some concrete numbers. During the Panic of 1907, an estimated $100 million was withdrawn from banks, equivalent to over $3 billion in today's dollars due to inflation. The Panic of 1907 saw the stock market lose significant value over several weeks, although exact figures are debated among historians. Imagine if your portfolio experienced a substantial decline over a similar period, but here's another twist. Despite all the chaos and loss, many individuals saw investment opportunities. After the panic subsided, some investors, including J.P. Morgan, were able to acquire assets at depressed prices, which led to significant gains as market conditions improved. Now let's bring it back to today. Financial crises still occur, but they appear different due to improved regulatory measures. People are generally more informed about money management, emergency funds, and the importance of diversification, which can help them navigate financial crises more effectively. So while J.P. Morgan's actions were crucial for stabilizing the system during the Panic of 1907, his legacy lives on in the form of modern financial safety nets and regulations designed to prevent future crises from spiraling out of control. But here's the ultimate takeaway. No matter how sophisticated our systems become, financial education remains crucial. Understanding how to manage your finances wisely can make all the difference during challenging times. Subject: The Panic of 1907. J.P. Morgan's rescue plan. In short, J.P. Morgan's quick thinking and decisive action helped stabilize financial markets during the Panic of 1907. However, his legacy also underscores the need for better oversight and regulations, a lesson that remains relevant today. This is educational and historical, not financial advice.